actually moving after we hit new record highs yesterday. We are awaiting the July jobs report. As you know, expectations call for an estimated 870,000 new jobs added to the economy in the month of July as the economy continues to rebound from the pandemic. Dow Industrials right now up 7, NASDAQ down 12. Joining me right now is Federated Hermes senior equity strategist Linda Duessel. Also joining the conversation all morning long this morning, Fox Business's Dagan McDowell and Strategic Wealth Partners President and CEO Mark Tepper. Great to see everybody this Friday morning. Thank you so much for being here. Linda, kicking things off with you. We're waiting on this jobs report. How important is this jobs report to the markets? Do you think it's going to be a market mover? What do you expect?
Well, thank you. Good morning, Maria. We're actually expecting a lower figure than consensus is expecting for the jobs report. Doesn't mean anything terrible at all. The month of July, the mid-months of the year, are historically kind of messy. And then July historically is subject to big revisions on the upside. So it's really a hard one to guess after coming out of this pandemic and everything. So whatever it is, we're still on a good trajectory. If it's below expectations, it's still good and steady as we make our way. No news really to look at until after September and those extra benefits roll off.
Yeah, I guess once the extra benefits roll off, we'll have a better idea of really what's going on in the economy. But of course, they're negotiating more spending, Linda. West Virginia Senator Joe Manchin is raising concerns on the rate of inflation as record numbers of stimulus circulate the economy. The senator flagging the impact of easy money policies in a letter to the Federal Reserve Chairman Jay Powell. Look, Manchin wants Powell to take his foot off the gas here and stop with all the free money. What are you thinking is going to happen here? How does this play out? We've got the Jackson Hole meeting coming up this month. That's one time that many strategists think that we'll hear more about the Fed's plan to ease up and begin that taper program. How do you see it playing out?
Yes. Well, I think this is one of the biggest concerns that we should have over the longer term. Is that all this stimulus, fiscal and monetary, has really been so outsized in the United States versus the rest of the world, and it's going to be very, very noticeable if we continue with another $3.5 trillion stimulus package. And I think what Manchin's doing, he's known to be the voice of reason from both sides of the aisle there, and he's maybe saying something also to his own colleagues. We really shouldn't go as high as we're saying now. The economy is much better. I think maybe he's giving a message to them as well. Both fiscal and monetary stimulus need to take their foot off the brakes. And we think that when they do meet at Jackson Hole, that the Fed will start to talk about a tapering. And that would be a really good thing, I think, for the long term.
So what do you want to do then, Linda? Do you want to hold on to stocks? Do you want to ease up on growth? How do you position yourself?
Yeah, I know this whole growth versus value debate and rotation is going on right now. The growth advance over the last 3 months is really mainly from the tech sector itself, which is 42% of the size of that index. But truly what's happening is that investors are behaving as if we're mid-cycle, and that's commonsensical. That's good. They're just looking for the better companies on both sides of the growth and value aisle. The main thing about where we are now, and I've been cautioning for a year and a half now, dangerous to be a bear. There's too much free money going out there. If the Fed should start to taper, it's still good low interest rates. That's good for your PE. We have had the highest earnings beats rates in history, and furthermore, the highest revisions going forward in earnings. PEs and earnings looking good. That's all good. And if I may, sentiment. I just read a statistic. Only 18% of the money that is now going into bonds and money markets is going into equities. That is not frothy. It's dangerous to be a bear right here.
Well, I love that. It's dangerous to be a bear, and you're right, because we keep seeing new record high after new record high, Linda. Let me bring in Mark Tepper here. Mark, where do you sit on this value growth debate? Obviously, growth was the winner for so long, but recently that's rolled over, although I don't know, because you're still seeing record highs in tech as well. Where are you on this debate?
So we prefer growth right now over value as well. I mean, when you look at growth versus value, I think you go back to about May 12th or so. That's when all of a sudden tech started outperforming substantially. Interest rates, obviously, the yield on the 10-year Treasury has come down. So we like growth, but we also like growth at a reasonable price. So the valuation has to make sense. So that's kind of where we're looking right now. But, you know, as you mentioned, Maria, the S&P just notched, I believe it's 43rd all-time high of the year.
Wow.
And all that despite a number of headwinds. You've got a murky job situation, the Delta variant, supply chain issues. So everything's looking pretty strong under the surface. Market looks strong. I think growth is still where you want to be right now.
Well, you saw what we were just showing on the screen, those graphics about inflation, right? Gasoline is up. Food is up. Do you worry about a disruption when the Federal Reserve gets to that Jackson Hole meeting in a couple of weeks? Jay Powell's speech?
I'm not as concerned about a disruption. So, you know, if you actually go back through history and you look at the very first time there is an interest rate hike, the market actually performs pretty well in the following 3 to 12 months after that. I'd love to hear Linda's take on that, though.
Yeah, final word, Linda. Go ahead.
Yeah, well, historically, when the yield curve is as steep as what it is right now, that's when the Fed would start to raise interest rates. And it's curious to me that the Bank of England just this week is evidencing that they're going to maybe start tightening quicker. This puts the spotlight on the Fed. That's a good thing for them to start thinking about doing this. But remember, we are extremely, extremely easy now. Tapering is nothing. It's the anti-taper tantrum, if you will.
Yeah, you know what Jamie Dimon said this week to me, that the Federal Reserve is going to start when it sees the whites of the eyes of the recovery, and he sees the whites of the eyes as 4.5% unemployment, 4.5% unemployment. I really like that comment from the chairman and CEO of J.P. Morgan, who joined us earlier this week. Linda, it's great to see you. Have a good weekend. All right, we'll talk soon.